Howdy, folks. Welcome back. It's the Liberty Call for Thursday, January 13th, 2022. I hope everyone out there in the interwebs is having a fantastic Thursday. It's pretty good here, kind of overcast, some sun, not too much, but, no snow, which is nice. My The forecast shows that we're supposed to get a little snow on tomorrow evening. So, with the way the topography is here where I live, there's they call it the Palmer Lake effect, and it has to do with the Palmer Divide, which separates where water runs. Everything north of the Palmer Divide, which is just right around Monument, Colorado. Everything flows north, and then everything south of the divide flows south. So it has some strange effects when it comes to snow. We get just hammered here in this little kind of curve in where you have this ridge, and then you have the mountains. So, anyways, not that y'all care out there. So, if it's your first time watching or listening, be sure to subscribe, like, and share with friends and family. I would greatly appreciate it. If there's some folks out there who maybe want some clarification on what's going on in the world, and you really don't care for the spin that you get from the TV channels and the media, I'm your guy. So, not that I'm perfect, but I at least try to give you an opinion that is free of the left and the right. I am a libertarian, small L, not a big L, but it definitely I try to give you my point of view. So, all right, well, let's go ahead and jump into the big news of the day. The Supreme Court has blocked vaccine mandates for large businesses, although it does allow for healthcare workers. So let's kind of breeze through this. I know the people on Twitter were freaking the hell out. I mean, you would have thought they took away their welfare. All right. The Supreme Court issued two highly anticipated rulings on Thursday, temporarily blocking the Biden administration's COVID-19 vaccine mandate for large employers, but allowing a separate rule to apply to only healthcare workers at facilities that receive federal funding. The High Court settled the matter concerning large employers on a 6-3 decision to block the rule that would have been issued by the OSHA, with 3 liberal judges dissenting. Well, there's a shock. I mean, the High Court is as partisan as the legislature, and I mean the country for that matter. It's like, I mean, I can't necessarily speak for the right because I came from the right originally, and I have my own bias. But it seems like the left always seems to just go with whatever the party line. So I don't know if that's really how the justice system is supposed to work. In my opinion, they're supposed to just look at the facts. Is this legal or not? I personally don't see where the federal government has any jurisdiction to tell anyone running a business that their employees have to be vaccinated or not vaccinated or tested or whatever the case is. I mean, the federal government's role in commerce is more or less just to make sure that there's commerce between the states. I don't think there's anywhere in the Constitution that says that the federal government can levy rules on businesses. So just for how you decide to run it. But anyways, OSHA has never before imposed such a mandate, nor has Congress. Indeed, although Congress has enacted significant legislation addressing the COVID-19 pandemic, it has declined to enact any similar measures to what OSHA has promulgated here, the majority opinion stated. As for healthcare facilities, the court ruled 5-4 to uphold the rule the rule administered by the Department of Health and Human Services, with Justices Clarence Thomas, Samuel Alito, and Neil Gorsuch dissenting. Both Medicare and Medicaid are administered by the Secretary for Health and Human Services, who has general statutory authority to promulgate regulations and may be necessary to the efficient administration of functions with which he is charged. One such function, perhaps, is most basic, given the department's core mission to ensure that healthcare providers who care for Medicare and Medicaid patients protect their patients' health and safety, the majority stated. Again, I I don't even agree with this one. I mean, yes, the federal government can decide what strings are attached to federal money. To me, this just seems a bit over heavy-handed. But anyway, so if you're a liberty lover like myself, you see this as a win. But anyways, let's move on back over to the stock market and see how things did there. The major world indexes, here in the US, the Dow Jones was down 0.49 to settle at 36,113. S&P 500 was down 1.37%, closing at 4,661. The NASDAQ was down 2.51%, closing at 14,806. Small caps were down 0.88. The VIX rose 15.27% to close at 20.31. So, that's not ideal. I know I talked yesterday. The VIX was down in the 17s. So that was certainly a much better number. Unfortunately, with where things are headed right now, volatility is just something we're going to have to live with until inflation and interest rates normalize. So, it's going to be tough. Across Europe, looks kind of mixed. I see, red and green. Nothing too high or too low in either direction. And across Asia, and let's see, mostly red. New Zealand was, Australia was up 0.48. New Zealand was down 0.05. Across Asia, the Shanghai was down 1.17. The SZSE component was down 1.96. The China A50 down 1.67. The DJ Shanghai down 1.33. And the Hang Seng was up 0.11. So most of Asia, looking at the overnights, was down except for a couple spots, Australia and the Hang Seng. Europe, kind of a mixed bag. And then across the US, we have everything looks down except for, I believe, the Dow Transports and Utilities were up. So, all right. Well, so that's how the market has fared today. Let's look at a couple of articles that I found fairly interesting. The first one, the dollar extends drop as positioning and technical selling way. This was written by Saqib Iqbal Ahmed from Reuters. Let's go ahead and read through this and see what they have to say. The dollar extended its fall against a basket of currencies on Thursday to a 2-month low, a day after data showed that an expected surge in U.S. consumer prices in December fell short of offering any new impetus for Federal Reserve policy normalization efforts. The U.S. dollar currency index, which tracks the greenback against 6 major currencies, was down 0.1% at 94.866, its lowest since November 10th. The index, which rose 6.3% in 2021, is down about 1% for the week, on pace for its worst weekly performance in about 8 months. So, I mean, I know I've talked about this off and on over the last year, as far as, paying attention to the dollar index. If it falls below 90, I think, that should be a sign that the currency is in some real trouble. So I've really been shocked over the last year to see the dollar strengthen against the other currencies. I don't know if that's necessarily shows the status of the dollar, or it shows how poorly the other index or the other currencies are in relation to the dollar. So, it's kind of like pointing out the tallest midget in the room. You say, hey, you're a giant. But in reality, compared to the general population, you're still a midget. So midget's probably the wrong word to use. Sorry if I'm offending any of you woke-tards out there. All right. Coming into the new year, the dollar positioning was very much skewed to being long, said Mazen Issa, senior FX strategist at TD Securities. Yesterday's inflation numbers, in conjunction with Fed Chair Jerome Powell's testimony for his nomination hearing, were basically just in line with what the markets had already positioned for. There wasn't anything materially new. I could have told you that. I mean, it's been advertised that they're going to raise interest rates this year, and they're going to have to start trimming the balance sheet. So, it's funny reading articles, now, when, anyone with, their head not stuck halfway up their rumpuses would have known this last summer or last fall. But hey, better late than never. Nevertheless, traders do not see these inflation readings as urgently shifting an already hawkish Fed too much. With at least 3 interest rate hikes already in the market price, some investors paired bets on future dollar gains. Powell on Tuesday gave no clear indication that the Fed was in a rush to speed up plans for tightening monetary policy, putting some downward pressure on the greenback, which has benefited in recent weeks from expectations for a rapid pace of policy normalization. The producer price inflation slowed in December as cost of goods fell amid signs that stretched supply chains were starting to ease. Hopeful signs that inflation has probably peaked. TD Securities ICE attributed part of the selling pressure on the greenback to technical factors, with the euro on Wednesday rising above the 1.14 level for the first time since mid-November. Once we get through the dollar, the 1.13 level, momentum players likely flip to sell dollars on that movie said. International monetary market speculators exited in 2021 with a long net position in the dollar that was close to the largest it had been in 2 years. The scale of dollar sell-offs must surely be partially indicative of positioning, MUFG analyst Derek Halpenny wrote in a research note. All right. So, like I said, the dollar, I mentioned this a couple times this week, what is going to fall apart first? Is it going to be is it going to be the dollar? Is it going to be the economy, or is it going to be the government? So I think, by the end of this decade, all 3 of those things will probably be gone. What sort of government we have over the states at that point by the end of this decade, I have no idea. Hopefully the republic goes away altogether. That would be ideal. I'm tired of donating a third of my salary to wasted endeavors, murdering people in the Middle East and all these ridiculous government jobs that we're paying for. But like I said, I am optimistic. I think better things are ahead of us once we get rid of the albatross that is the federal government. But until then, we have to live with it. All right. Next article, real wages. Turn that back on. Real wages plummet as inflation hits the U.S. recovery. So let's go ahead and dive into this. Let me see if I can make the text a little bigger. All right. The headline 3.9% unemployment rate looks positive, but job creation fell significantly below consensus at 199,000 in December versus a consensus estimate of 450,000. The weak jobs figure should be viewed in context of the largest stimulus plan in recent history, with massive monetary and fiscal support and a government deficit of 2.77 trillion, the second highest on record. Job creation falls significantly short of previous recoveries, and the employment situation is significantly worse than it was in 2019. The most alarming data point is that real wages are plummeting. Average hourly earnings have risen 4.7% in 2021, but inflation is 6.8%, sending real wages to negative territory and the worst reading since 2011. The number of persons not in the labor force who currently want a job did not change in December at 5.7 million. That's still 717,000 higher than February of 2020. The number of long-term unemployed, those jobless for 27 weeks or more, remains at 2 million in December, or 887,000 higher than February of 2020. Long-term unemployed accounted for 31.7% of the unemployed, according to the Bureau of Labor Statistics. The labor force participation rate remains at 61.9% in December and has been stagnant for almost 12 months. Labor participation remains 1.5% points lower than its February of 2020. Finally, the unemployment to population ratio is just 59.5%, or 1.7 percentage points below the February 2020 level. Now, put this in context of a massive $3 trillion stimulus, and the evidence is clear. There is no bang on the buck from the unprecedented spending spree. All the jobs recovery comes from the reopening. The stimulus plan has not accelerated job growth. It has slowed it. A few months ago, I had a conversation with Judy Shelton, one of the top economists in the United States, and she mentioned that the recovery would be stronger without stimulus plan, and she has been proven right. No citizen should be happy about plummeting real wages and stagnant labor participation in the middle of a strong recovery and the second largest deficit on record. The unprecedented figure of resignations is not positive, It's evidence of a broken labor market where hundreds of thousands of Americans cannot afford to go to work because the costs outweigh their salary. This is not a signal of strong employment. It is a signal of genuinely concerning side effects of inflation. The United States is not even close to full employment. Erasing people from the unemployment list is not full employment. This is a clear threat to American workers, from persistent high inflation to the higher taxes that the massive deficit includes, the destruction of the middle class, and fewer job opportunities in the future as small and medium enterprises, the largest employers in the United States, suffer rising input prices and weaker margins. The United States will not have a strong job market unless it recovers the trend of rising real wages and increasing labor participation rate that existed in 2018 and 2019. Everything else is just a poor and unproductive bounce. I have to agree. I mean, this, I was certainly against all the stimulus over the last 2 years. All it does is just raise debt levels and increase inflation. There's nothing like government. They'll break your leg and then sell you a crutch, and then want congratulations and thanks for being so generous to you. So, yeah, I mean, it's not to say that anyone with a brain couldn't see this, but unfortunately, those in Washington, I think, get lobotomized when they first check in for their first session. So, all right, last article is some rules around IRA or Roth IRA withdrawals. So I figured this is some good information for those. I know I probably reiterated this, hundreds of times over the years to clients, but never hurts to go over the numbers with people again. All right. Let's see here. The rules or the withdrawal rules for Roth individual retirement accounts are generally more flexible than those for traditional IRAs and 401ks. Still, you want to do your homework before making any Roth IRA withdrawals. If you don't meet certain requirements, you could end up owing taxes and a 10% early withdrawal penalty. Contributions and earnings. Roth IRA withdrawal rules differ depending on whether you take out your contributions or your investment earnings. Contributions are money that you deposit into your IRA, while earnings are your profits. Both grow tax-free in your account. You can withdraw your Roth IRA contributions at any time for any reason with no tax or penalties. That's because you make contributions with after-tax dollars, so you've already paid income taxes on that money. Withdrawals on earnings in the account work differently. These distributions may be subject to income taxes and a 10% penalty depending on your age and how long you've had the account. The annual contribution limit for both traditional and Roth IRAs is $6,000 for 2021 and 2022, and the catch-up provision for those over 50 is $1,000. Roth IRA income limits. The annual amount you can contribute to a Roth IRA is limited and can be phased out depending upon how much income you earn. For the tax year 2021, the income phase out for singles was 125 to 140. For 2022, contribution phase outs are from 129 to 144. In other words, contributions cannot be made to a Roth if your income exceeded $140,000 in 2021 or $144,000 in 2022. For married couples who file a joint tax return, the Roth income phase outs for 2021 is 198 to 208 and 204 to 214,000 for 2022. The Roth IRA 5-year rule. In general, you can withdraw your earnings without owing taxes or penalties if you're at least 59 and a half years old and it's been at least 5 years since you first contributed to any Roth. The 5-year rule. 5-year rule applies. The 5-year rule applies regardless of your age when you open the account. If you were 58 years old when you made your first contribution, for example, you have to wait till you're 63 to avoid taxes. The clock starts ticking on January 1 of the year you made your first contribution to any Roth. Because you have until April 15th of the following year to make a contribution, your 5 years might not be a full 5 calendar years. For example, if you contributed to your Roth in early of April 2020, but designated it for the 2019 tax year, you only have to wait until January 1st of 2024 to withdraw your Roth IRA earnings tax-free, assuming you're at least 59 and a half years old. When with Roth IRA conversions, the 5-year clock starts on January 1 of the year you made the conversion. And for inherited Roth IRAs, it starts when the original owner made the first contribution, not when the account is passed on by inheritance. Qualified distributions. Qualified distributions are tax-free or penalty-free. As far as the IRS is concerned, a Roth IRA distribution is considered a qualified distribution if you meet the 5-year rule and the withdrawal is made on or after the date you turn 59 and a half, taken because you have a permanent disability, made by a beneficiary or your estate after your death, or used to buy, build, or rebuild your first home, a $10,000 lifetime maximum applies. What are non-qualified distributions? Non-qualified distributions are the withdrawals that don't meet the IRS guidelines for qualified distributions. You'll pay taxes at ordinary income. You'll pay taxes at your ordinary income tax rate on earnings plus an additional 10% penalty. However, you may not have to pay the 10% penalty if one of these exceptions applies. You're taking a series of substantially equal distributions. You have unreimbursed medical expenses exceeding 10% of your AGI. You're paying medical insurance premiums after losing your job. Your distribution is due to an IRS levy. You're taking qualified reservist distributions. You need the money for qualified disaster recovery. You're taking the distributions to pay for qualified education expenses, and you're covering the cost of childbirth or adoption up to $5,000. All right, so looks like, and let's see what it has to say here about the first-time homebuyer exception. There are several IRS exceptions that let you take money out of your Roth without paying a penalty. One of the key ones is for first-time homebuyers. Interestingly, you may still qualify as a first-time homebuyer even if you've owned a home in the past. If you meet the 5-year rule, you can avoid taxes on the withdrawal. However, if it's been fewer than 5 years since your first contribution, you'll pay income taxes on the earnings portion of the distribution. Withdrawals from a Roth IRA come in a specific order: contributions, money converted from another account, and then earnings. There's a $10,000 lifetime cap. So if a one-time deal, so it's a one-time deal for most investors, but because contributions come out first, many investors won't need to dip into their earnings. This means they can avoid taxes. Once you withdraw the money, you have 120 days to use it to buy, build, or rebuild a home. According to the IRS, you can also use the money to help a child, grandchild, or parent who meets the first-time homebuyer definition. Higher education expenses. You can take penalty-free withdrawals from your Roth IRA to pay for higher education expenses at a college, university, vocational school, or post-secondary educational institution, but you'll still be on the hook for income taxes on the earnings portion. Qualified expenses include tuition, fees, books, supplies, required equipment, and room and board if you're at least a half-time student. The distribution can be used to help out your spouse, children, grandkids, or great-grandkids, but no matter who benefits, the withdrawal can't exceed your higher education expenses for the year. Keep in mind that Roth IRAs and other retirement accounts aren't counted as assets on FAFSA. However, withdrawals count as income. That means if you use your Roth to pay for education expenses, it can reduce the amount of financial aid you can receive. You can take a withdrawal, but should you? If money is tight, the Roth IRA withdrawal can be an easy solution. Still, if you find another way to make ends meet, do so. You'll avoid any potential tax or penalties, and more importantly, you'll keep your retirement savings intact and on track. And you can't repay money that you take out of your Roth IRA. Once you make the withdrawal, that money and its potential earnings are gone forever. Roth IRAs boost tax-free growth and tax-free withdrawals on qualified distributions. If you withdraw money, you could miss out on years or even decades of tax-free earnings growth. That, of course, can make a big bite out of your retirement nest egg. This is the biggest drawback to taking an early withdrawal. All right, so I think that's about it. I've been rambling for 23 minutes, so I appreciate anyone who's actually paying attention this long into the recording. So that's all I have for today. If anyone needs anything from me, or you have questions, or you want to book an appointment, please do. Put my email address back there. So you're welcome to send me an email or go to my website, dsafinancialgroup.com. And there's a spot on there where you can click to book an appointment or send me an email if you have a question. So, all right, well, that's everything I have for today. If anyone needs anything from me, don't hesitate to shoot me an email or drop me a call. And I will be back tomorrow with the weekly wrap up. And everyone have a fantastic evening.